Let's talk inflation. Why it happened after COVID pandemic. In this video, you'll learn exactly what caused the spike in inflation after the COVID pandemic. Most people don't grasp exactly what happened because our political parties don't want to admit it, and the media only reports the talking point headlines. In 2008, the US financial system experienced massive asset destruction when the housing bubble burst, taking down a superstructure of derivative mortgage products. To keep banks afloat, the Federal Reserve began creating money and purchasing assets. The US monetary base went from the now quaint level of $850 billion in August 2008 to more than $2 trillion in March 2010. Occasional attempts to slow its growth thereafter caused sharp drops in the stock market, which forced the Fed to keep easing. By late 2014, the monetary base had topped $4 trillion. But where was the inflation? It didn't happen because people weren't borrowing and/or the banks weren't lending. U.S. bank excess reserves held on deposit at the Fed had historically been an even more quaint $2 billion or less. But after 2008, they put the flood of cash on deposit at the Fed, accumulating $2.6 trillion in excess reserves by late 2014. This resulted in declining velocity of circulation, which neutralized the effect of the monetary expansion. Things began to change after 2016. From October 2017 to September 2019, the Fed managed to taper the monetary base from $3.8 trillion to $3.2 trillion. Trump administration tax cuts began to give confidence in the economy, and banks began pushing loans out the door, reducing excess reserves from $2.1 trillion to $1.3 trillion. The combination of increased lending, Fed tightening, and real economic growth soaked up the circulating money, and inflation couldn't get started. Then came COVID. In January 2020, the US monetary base was holding steady at $3.4 trillion. When the shutdown occurred and federal spending soared, the Fed flooded the market, and by May 2020, the monetary base had reached $5.1 trillion. There was a brief pause in the latter half of 2020, then starting around November 2020, it began growing again, hitting $6.4 trillion in November 2021. That's a 7.5-fold increase in the US monetary base from 2008 to 2021. Once again, the banks held on to the new money as excess reserves, which doubled from $1.5 trillion to $3.2 trillion between February and May 2020. But in March 2020, to encourage more lending, the Federal Reserve enacted a rule change that eliminated reserve requirements. Most people think banks hold a fraction of deposits on reserve in case customers want to withdraw money. They used to, but no longer. In Canada, they haven't had reserve requirements since the 1990s. And since March 2020, they're not required in the United States either. Instead, other regulations cap the volume of loans banks can make in relation to their market capital. Also, in winter 2020, the banks experienced a rapid increase in consumer deposits because so many consumer spending categories were shut down. The combination of events resulted in a boom in total deposits in U.S. banks, which went from $13.5 trillion in March 2020 to $15.6 trillion by June 2020, the biggest jump ever, and the growth rate tilted upward. Deposits topped $18 trillion by the end of 2021. This expansion of liquidity in the U.S. banking system, coupled with the elimination of reserve requirements, is an unprecedented monetary stimulus that makes the post-2008 measures look like chump change. Unfortunately, it coincided with the Biden administration's fiscal stimulus package in 2021 and a series of negative supply shocks. Supply chain disruptions that began with COVID shutdowns were exacerbated by transportation logistic problems at major U.S. ports and in the North American trucking industry. Then stimulus payments and the Great Resignation triggered a labor shortage, just as the Russian invasion of Ukraine slashed global energy and food supplies. The combination of monetary expansion, demand stimulus, and supply contraction all but guarantees an extended bout of inflation. Unlike post-2008, velocity is not shrinking to offset the monetary expansion. Since 2020, velocity has been flat, possibly because the flood of deposits and the elimination of reserve requirements has convinced banks to expand their loan portfolios. The extra money is now out in the economy while there are fewer goods for it to chase, slower job growth, and less investment in expanded output. In summary, inflation was caused by excessive government stimulus from both the Trump and Biden administrations. $2.1 trillion in tax cuts in 2017, elimination of bank reserves in March 2020, the $2.2 trillion Coronavirus Aid, Relief, and Economic Security Act, known as the CARES Act, passed by Congress and signed by Trump in 2020, a $1.9 trillion American Rescue Plan signed by the Biden administration in 2021 to accelerate the economy after COVID and supply shocks and disruptions, and a Federal Reserve who insisted the inflation was transitory and waited to start hiking interest rates.